Hello students and welcome to the lecture. So students, as we know that we were covering the financial knowledge and the banking awareness part of it, and basically in the previous lecture we had started the discussion over the banking evolution. Okay, and we were discussing the term more details on the banking evolution. So basically in this lecture we are going to continue with the same topic and we will discover some new facts and figures. I hope that you have revised the previous facts before you have come for this lecture because it is for your own benefit. Alright, as we know, we are revising the previous terms which we had already covered. And second, we are discussing over new facts and figures. Okay, that's what we are doing. Okay, so let's start. This is the topic. This is the topic what we are covering. Okay, about Jain and Vaishya merchants we had covered. About Kangals and Khatris we have covered. About Hawala system I had explained you in detail. This is the thing which we need to understand in today's lecture. Early banking practice in India were built on mutual trust, social networks, and personal relationships. Banking transactions often involve community members or relatives. Okay, like you remember, I had told you banking in ancient or previous times were basically done by informal sectors. Okay. So now the question arrived in front of us is that what do you mean by the formal sector or informal sector? Okay. All right. Then only we could understand what you mean by the informal sectors. Okay. So basically, first we talk about the formal sectors. Okay. In the current scenario, formal sector banking refers to the practicing of banking activities by the institutions or organizations of country or abroad as per the rules and regulations which are described by the proper acts. Okay. So in the formal sector banking refers to the practicing of banking activities by the institutions or organizations of country or abroad as per the rules and regulations described by the proper acts. Okay, and basically if we talk about India, then any Indian bank or foreign bank, okay, whether the bank is of Indian origin or of the foreign origin, could do the banking practices as per the Banking Regulation Act 1949. Okay, about this act we will have a discussion in the upcoming topic. Till then, just remember, in India, all the banks, whether they are Indian bank or of the foreign banks, they have to do their banking practices as per the Banking Regulation Act 1949. Okay, it is a formal sector bank. Second is a informal. Informal sector. Okay. So basically, informal sector banking is the practice of banking activities as per the individual or group of individuals own set of rules and regulations, or you can say own terms and conditions. Okay. So basically, in formal sector, there is a banking practices as per the set of rules and regulations or terms and conditions designed by the individual or a group of individuals. Basically, in individuals category, we could take a example of a person who is the money lender. Okay, because they grant a loans to the people in need as per their own interest and as per their own needs. Okay, whereas when we talk about the group of individuals, then these are the merchants. Like we had take examples of Jains, Vaishyas, Kangals, and Khatris. Okay, so the above one is the formal sector, the lower one is the informal sector. And what is the basic difference between them? The first is formal sector banking is governed by the prescribed rules and regulations. Okay, which means there is authenticity in actions and responsibility of an organization towards clients and country would be checked. Okay, in formal sector banking, because there is a proper set of rules. Like I had given you example, there is a Banking Regulation Act 1949 which governs the banking practices in India. Okay, so it means that the authenticity in actions could be defined. Okay, like do's, like do's and don'ts of activities by the banks and the financial institutions could be defined and controlled. Okay, the responsibility towards their clients meant the interest they are charging. Okay, like there should be no partiality in loan granting. Okay, there is a transparency in actions. All of the things could be governed for their clients and for nation, means that to whom they are granting the loans, is this an organization harming the country's interest, or there is nothing which could harm the interest, like terror organization, okay, foreign intelligence. If this kind of agencies are basically funding by the banks in the formal sector, then there could be a serious consequences of it. Okay, whereas in formal sector, do not have any rules and regulations to define their credibility towards their actions for client and for nation as well. Because there are no rule to control them. There is no definition of do's and don'ts for them. Which means what? There could be a no defined credibility for their actions towards the client, like whatever the interest is they are charging, to whom they are entertaining, okay, what is the collateral security they are taking, and towards the nation. Because there is no checking for them, so they could even fund the terrorism or the foreign intelligence. Okay, and the best system of this is Hawala system, because Hawala is a part of informal sector. So now I think that you have got a better understanding of the formal informal sector. Now come to the part that in the previous times or in the early banking practices in India, basically there is a mutual trust, social network and personal relationships. Okay, and banking transactions often involve committee members or relatives, because there was no organization to be called as bank. Okay, and even the only source of banking practices were like a hundi system, hundi system. Okay, like a adesh, all right, like money lending. Okay, all kind of these things were there, which are simply means on the mutual trust, okay, and community, because there is nothing for the rules and governing, rules and regulations, you can say. All right, so remember this thing. Now let's move forward. Thereafter we have the chits and committees. Okay, chit fund and committees were common ways of saving and pooling money in communities. Members would contribute regularly and the collected funds would be given to one member in a rotation. Now, the first is, what do you mean by chit fund? Okay, and what do you mean by community? They both are having the single origin. Okay, but their loan granting practices is different from each other. And how? Let's understand. The best way in today's scenario to get the loan is that reaching the banking institution or financial institution to get the loan. Okay, but for this process you must need a proper documentation. Like if you have ever approved your loan from the banks, you must know that there are a various process for the documentation. Okay, second is the approval. Okay, even after documentation. If the bank does not find your file to be suitable for granting a loan, they will disapprove the loan. So approval is again the major cost. Okay. Thereafter, the third one is the collateral security. Okay. Which means that if you want a loan for rupees 10 lakh, you must submit it something with the bank of worth rupees 10 lakh. So in case if you are defaulting to repay the loan, the bank will sell out your product to recover the money. And the fourth point is interest rate. How much interest is charging by the bank? Okay. And the meaning of it is like that. Suppose you are taking rupees 10,000 at 5%. You are able to get it for 2 years. Just an example, you are able to borrow 10,000 at 5% for 2 years. It means that by the calculation of simple interest, 1,000 rupees you are required to give to the bank along with the principal amount, because when you repay the loan, you have to pay the principal amount as well as the interest. So total amount you will submit it to the bank will be around 11,000 rupees. Okay, that's what you could afford. So you want that your loan should be granted at only 5%. Okay, but somehow, suppose you having a need of 10,000, but the bank is granting the loan at 20% for 2 years. Okay, which means that 10,000 into 20 for 2, rupees 4,000 along with the principal you have to repay to the bank. Total 14,000 you have to repay. Okay, how much you could only afford? 11,000. But how much you have to pay? 14,000. It means that 3,000 is a excess you need to pay to the bank. Okay, so now the question is, are you able and are you willing to do it? The answer is clearly no, because you could not afford it. Okay, so interest rate should be as per your need. The fifth point is that time period. Time period is also very essential when you're going for the loan process. How? Let me tell you. Suppose you are okay to borrow 10,000 at 20% interest. You said, okay, if you're not giving it on 5%, I am able to buy it on 20%. You're able for it. Okay. But for only in condition of 8 years. Okay. Which means that 10,000 into 20 into 8. $16,000 you have to pay as a interest. It means that the total amount will be principal plus interest is equal to 26,000. This is the amount you have to pay to the bank. The principal was only 10,000 and the amount will be this, but only for if it is for 8 years. Because suppose you are investing that money 10,000 somewhere and you are promised to get the interest of 40%. So if you invest it for 8 years, okay, how much you will get? 32,000 you will get. Okay. So as per the calculation, 16,000 will be your profit Sorry, 6,000 will be your profit. Okay, in that condition. So still you are able to borrow it because you will earn 6,000 and then you can give the rest amount to the bank. Okay, but if there's a condition that 10,000 at 20% is granting only for 2 years. Okay, so it means that 4,000 is the amount you need to repay along with the interest. Principal, sorry. So 14,000 amount you need to pay. Okay, then the place where you are investing it, it means 10,000 at 40% for 2 years you are investing it. Okay, so 10,000 into 40 into 2 means that 8,000 is the interest you need to prepay. Sorry, you will get it. Okay, how much you have to repay? 14,000 principal plus interest. Okay, so now we have chits and committees. Okay, chit funds and committees were common ways of saving and pooling money in committees. Members would contribute regularly and the collective funds would be given to one member in rotation. Okay, to understand the topic, we first understand what do you mean by the chit fund and committee. Okay, basically their way of origin is same. Okay, but their loan granting activities are different. Okay, how? Let's understand. So first, if we talk about like a person who wants to get the loan from any banking institution or financial institutions. So what are the steps he has to follow? The first step is documentation. Okay, like you have to submit your documents. Okay, then the next step is approval. The documentation in itself is a big task because you have to get your documents verified by the banks. Second one is the approval. Like even after the documentations, sometimes the bank find you ineligible or not sufficient to grant the amount. That's why approval is another big process. Thereafter, the third is the collateral security. Okay, like the thing which you have to submit with the bank in case of getting the loan. For example, suppose you are asking for the loan of rupees 10,000. So you have to give this thing worth rupees 10,000 to the bank. Then only the bank will allow you to take the loan. So in case if you default in repayment of the loan, the bank will sell out this property to recover its loan. Okay. So this is the third part. Okay. The fourth is interest. Okay. Interest is again the very crucial point. How? Let me tell you. Suppose you are willing to take the rupees 10,000 at interest of 2% only for 2 years. Okay. So if we take up the calculation, which means 10,000 into 2 into 2, divided by 100. You have to pay 400 as per the interest. So total amount payable is principal plus interest, which means that 10,400 will be the amount you are required to pay to the bank. Okay, but the bank is giving you 10,000 loan at 20% interest for 2 years. So if we take up the calculation, it means that 4,000 will be the interest chargeable. So now you're required to pay 10,000, which is the principal amount, along with the interest, which is 4,000. Total amount is 14,000 you are required to pay to the bank. How much you are capable to afford and how much you are paying. So this is why the interest rate is very, very crucial when you are going to take the loan from the bank. And the fifth step is time period. Time period is also important while taking the loan. How? Let me tell you. Suppose you are taking the loan of 10,000 at 20% interest for 2 years. Sorry, for 8 years. Okay, it means that rupees 10,000 at into 20 into 8 divided by 100. $16,000 will be the interest. So it means that the total amount payable is 10,000 plus the interest chargeable is equal to 26,000 you are required to pay to the bank. Alright. And then after taking the loan, you have invested it at 10,000 at the rate 40% for the 8 years, which means 10,000 into 40 into 8. $32,000 will be the interest you will get, okay, or your total money. Out of 32,000 which you get, how much you have to pay? 26,000 including the principal. So you will get rupees 6,000 as your profit. Okay. Remember the calculation? Now come to the next point. 10,000 at 20% for 2 years. Okay. So means 10,000 into 20 into 2. Total 4,000 is the amount you are required to pay to the bank. Okay. Along with principal, 14,000 is the amount you have to pay to the bank. Okay. Now, let's talk about investment. 10,000 into 40 into 2. Okay. 8,000 is the interest or total earning you are getting. Alright. So it means that 14,000 minus 8,000, 6,000 is your total loss you are occurring. Okay. That's why the time period is a crucial thing. Okay. So these are the several steps we have to follow while we're going to get a loan. Okay. But let me tell you one thing in a frankly way. These steps are not so easy to be followed. That's why the individuals often go for chit funds, and communities. Okay. If we talk about their origin, then their origin is basically the money pooling. What do you mean by money pooling? Suppose there are a group of 10 individuals. Okay. Then, as per the mutual decision, they all will contribute rupees 1,000 each. Okay. In a fund, which will be known as chit fund or committee fund. Okay. So the total amount in the fund will be rupees 10,000. Contributed by 10%, 1,000 each. So it is known as the money pooling. When the individuals groups contribute the fixed amount on the regular basis to the common fund. Okay. So basically, if we talk about the chit fund, okay, so the money lending is basically the lottery system. How? Suppose there are 10 individuals. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. These are the 10 individuals we have. Okay. They all contributed 10,000 in the fund. Okay. Then their name will be collected names will be collected in a common box. Okay. Then randomly one chit will be pulled out of from that box. And suppose their names are A, B, C, D, E, F, G, H, I, J. Okay. These are their names. So suppose if the one chit which had been pulled out contains the name of A, it means that 10,000 will be granted to A as a loan. As per B, C, D, E, the common rule will be applicable. Whose name will be in the chit will get the loan. Okay. That's why it is like a lottery system. You will get it or you can't get it. Whereas in the committee fund, there is a proper rotation. What do you mean by rotation? Suppose there are again 10 individuals. 7, 8, 9, 10. Whose names are A, B, C, D, E, F, G, H, I, J. 10 individuals these are. Okay. They are contributed 10,000 in the common fund, which is known as the committee fund. Okay. So now the money will be granted on the rotation basis. Suppose in the month of January, A will get the money. So in Feb, B will get. In March, C will get. In April, D will get. In May, E will get. In June, F will get. In July, G will get. In August, H will get. In September, I will get. In October, A will get. Again, in November, A will get. December, B will get. So this is known as a rotational shift. So these were also in the banking system. Okay. Now let's move forward. Okay. So these early banking practices in India reflect a rich tradition of financial activities deeply rooted in the socio-economic fabric of the country. All right. Modern banking practices has significantly evolved and become more regulated. These historical practices have left their mark on the financial culture of India because the early banking practices not only placed a platform for establishment of modern banks. Okay, but also provide a activities to be included in modern banking. Okay, like Hundi system, which is now known as the bills of exchange. Okay, like Adesha, which is now known as a legal notice to perform the activities. Okay, so this kind of things, activities provided by the banking systems. All right. So students, basically in this lecture, we have completed the first part of the more details. In the next lecture, we will revise the banks established over the time and we will try to connect them by one. Okay. Till then, just revise all the facts and figures we have discussed in this lecture and be ready for the another lecture. With this note, let's end this lecture and thank you.